Right now, in a data center in New Jersey, a server is making a decision in 70 microseconds. By the time you finish blinking, it has placed and canceled 4,000 orders. It is not thinking, it is executing a rule. And on the other side of that trade, most of the time, is a human. Roughly 70% of all US stock trading volume is now executed by algorithms. Not advisors with algorithms. Algorithms. The market you and I trade in is not a market of humans negotiating. It's a market of machines, with humans occasionally interrupting. Citadel Securities. $7.5 billion in net trading revenue in 2022. 2 Sigma. $60 billion under management. Renaissance Technologies. Their Medallion fund returned 39% net annually for 30 years. These are not lucky guesses. These are firms that turned trading into engineering. Meanwhile, on the other side, European regulators studied retail traders. The result? Between 74 and 89% lose money. Not in a year. On average. The market isn't random. It's structured. And the structure favors the side that does the math. Strip away the marketing. A trading algorithm is this: an if statement. With money attached, the if statement reads market data. If a condition is true, it places an order. If not, it waits. That's the entire concept. Everything else, speed, scale, sophistication, is just elaboration on this idea. What separates a hobbyist script from a professional algo isn't the signal, it's the layers around it. Signal generation tells you when to trade. Position sizing tells you how much. Execution logic tells you how to enter without moving the market against yourself. Risk management tells you when to stop. Most retail traders write the signal. They skip the other 3 layers. That's where the money goes. And then there's the data. Retail platforms show you a candlestick. Professional algos see the order book. Every bid, every ask, every cancellation, every modification, time-stamped to the microsecond. They see the rate at which large orders are appearing on one side. They see the imbalance. They see when a big player is hiding size. You can't read what you can't see. The other gap is speed. When you click Buy in your browser, your order travels through your broker, through internet infrastructure, to the exchange. Call it 200 milliseconds on a good day. A co-located algo sits in a server rack inside the exchange's own data center. Its order travels a few meters of fiber. Round trip, 70 microseconds. That's 3,000 times faster than you. By the time your click registers, the algo has already reacted to the news that triggered your click, traded against it, and moved on. How serious is this? Firms have spent hundreds of millions building dedicated microwave tower networks between Chicago and New Jersey because microwaves through the air are slightly faster than fiber through the ground. The savings, about 4 milliseconds. That's the kind of edge professional firms pay for. 4/1000ths of a second is worth a tower. So the first thing to understand is, you are not playing the same game. You're playing checkers against someone playing chess at 60,000 moves per second. Now let's look at what they're actually doing. Strategy 1. Breakout. The simplest, most studied pattern in trading. Price approaches a level. It gets rejected, approaches again, rejected, approaches a third time. Each rejection means there are sellers waiting at that price. The longer the level holds, the more orders pile up just above it. Stop-loss orders from short sellers, take-profit orders from buyers, fresh buy orders from breakout traders. When price finally breaks the level, usually on a wave of news, or a large buy order, or just enough cumulative pressure, all those orders fire at once. Stop losses trigger, becoming buy orders. Breakout algorithms see the level cross, fire their entries. Volume explodes. Price moves fast in the direction of the break. This is the real mechanic behind breakout. It's not magic. It's a chain reaction of pre-placed orders. Here's a real breakout rule in code. Define resistance as the highest high of the last 20 bars. Wait for a candle to close above it. Confirm with volume. Only take the trade if volume is above the 20-bar average. Set stop loss below the breakout level. Set take profit at 1.5 times the risk. This is a complete strategy. You can backtest this in TradingView in 20 minutes. And here's why Breakout is famous for losing money. Most breakouts fail. Price breaks above resistance, runs for a few candles, runs out of buyers, falls back below. The algorithms that bought the breakout get stopped out. The professionals on the other side, who were selling into that breakout, get paid. This is called a fakeout. It happens more often than not. If you actually backtest a basic breakout strategy on Bitcoin from 2020 to 2023, the win rate is around 38%, less than half. But the average winner is roughly 2.1 times the size of the average loser. So the strategy makes money, barely, because the few real breakouts pay for all the fakeouts. This is the structure of almost every real strategy. Low win rate, asymmetric payouts. You lose often. You win bigger when you win. If you can't tolerate losing 6 trades in a row while staying mechanically committed to the rule, this strategy is not for you. That's not a flaw of the strategy. That's why it works. Strategy 2, VWAP. Volume-weighted average price. Developed in the 1980s as an institutional execution benchmark. The line you're looking at is the average price of every share traded today, weighted by volume. It updates every second. And on most large-cap stocks, on most trading days, price returns to it like a magnet. Why does it act like a magnet? Because pension funds, mutual funds, and ETFs are required by their mandate to execute at or near VWAP. When BlackRock has to buy 2 million shares of Apple, they don't dump it in one order. They use an execution algorithm that slices it into hundreds of small orders spread across the day, designed to hit the VWAP. Their performance is graded against it. So billions of dollars of buying and selling are mechanically pulled toward this line every single day. This creates the second strategy, mean reversion to VWAP. When price gets too far from the line, say 0.4% below on a calm day, institutional buyers step in. They have to buy. They're behind their benchmark. So if you can identify those moments, you can ride the snapback to VWAP. The win rate on this strategy is much higher than Breakout, sometimes 65 to 70%, but the winners are smaller. Same total edge, different distribution. Here's the rule and code. Calculate VWAP from the cumulative price times volume divided by cumulative volume. Calculate the standard deviation of price from VWAP over the last 30 minutes. Enter long when price is more than 2 standard deviations below VWAP. Exit when price returns to VWAP, or when 1 hour has passed. Risk: 1% of account per trade. Position size scales with the distance from VWAP. And here's where it dies. Mean reversion works on calm days. On trend days, Fed announcement, earnings surprise, major news, the magnet breaks. Price moves 2% in one direction and never comes back to VWAP. The mean reversion algo keeps buying the dip, getting stopped out, buying again, getting stopped out. A single trend day can erase a month of small wins. This is why professionals don't run mean reversion blind. They overlay it with a regime filter. If implied volatility is above X, turn the strategy off. Every strategy has a market regime where it works and a regime where it dies. The amateur runs one strategy. The professional knows which strategy the current regime favors and turns the others off. A real algorithm is not one decision. It's a pipeline. Market data comes in. Order book updates, trade prints, news feeds. Features get computed, moving averages, volatility, order flow imbalance, sentiment scores. The signal layer asks, is there an opportunity? The filter layer asks, is the regime right? Position sizing asks, how much? Execution asks, how to enter without slippage. Risk check asks, are we within drawdown limits? Every order passes through all 7 stages, every time. Take feature engineering. On every single price update, which on a liquid market is dozens per second, the algo recomputes a vector of features, maybe 30, maybe 300, maybe 3,000 numbers. This is the input to the signal model. The model could be a simple if statement. It could be a logistic regression. It could be a gradient-boosted tree. The fancier the model, the more dangerous the overfitting risk. Renaissance reportedly uses thousands of weak signals combined. Most retail strategies use one or two strong-looking ones. Strong-looking signals are usually overfit. Position sizing is where most retail traders die. The professional rule is the Kelly criterion. Bet a fraction of your bankroll proportional to your edge. With a 55% win rate and a 1.5 to 1 reward-risk ratio, Full Kelly says risk 6.7% of capital per trade. Most pros run half Kelly, about 3.3%, to survive variance. Retail traders asked the same question will say, "I'll go all in if I'm sure." They are guaranteed to blow up, not because they were wrong about direction, because they were wrong about size. Execution is the layer most amateurs don't even know exists. If you place a market order for 10,000 shares of a small cap stock, you'll move the price against yourself by 1 to 3%. That's slippage. It quietly destroys a strategy that looked profitable in backtest. Professional execution algos slice that order into 100 child orders, send them to multiple exchanges, time them across minutes, hide them inside dark pools. The goal is to get filled at the average price, not the worst price. This is where companies like Citadel make their money, selling best execution as a service to brokers like Robinhood. And finally, the risk layer. Every order before it leaves the system gets validated against limits. Max position size, max daily loss, max exposure to any one sector, max correlation across positions. If the order would breach a limit, it gets rejected. Knight Capital lost $440 million in 45 minutes in August 2012 because a deployment bug bypassed exactly this layer. Old dormant code got reactivated, started flooding the market with bad orders, and there was no kill switch. 45 minutes. The firm nearly went bankrupt. The lesson: the risk layer is the only thing standing between a small bug and an extinction event. The signal makes the money. The risk layer keeps the money. Reason 1. Humans hold losers and sell winners. The technical name is the disposition effect, documented in academic finance for 40 years. When a position is up, the human brain registers a gain and wants to lock it in. When a position is down, the brain refuses to accept the loss and waits for it to recover. The result: small wins, large losses. Mathematically, this is the inverse of a profitable strategy. An algorithm doesn't have this bias. It cuts at the stop. Every time, no conversation. Reason 2. Humans can't sit through drawdowns. Every real strategy, including the best ones in the world, has stretches where it loses money. The Renaissance Medallion Fund had down quarters. Citadel had a near 40% drawdown in 2008. The difference is, they kept running the strategy. Most retail traders in the middle of a 30% drawdown abandon the system. They tweak parameters. They jump to a new strategy. They miss the recovery. The strategy works, the trader doesn't. Reason 3. Costs. Every trade costs you. The bid-ask spread costs you. Slippage costs you. Commissions cost you, even on commission-free brokers. They sell your order flow. Add it up. A retail trader making 10 trades a day at small size is paying roughly $40 a day in total transaction costs. That's $10,000 a year. To break even, you have to make $10,000 a year just to pay the casino. Most retail strategies do not have that much edge. Reason 4. Information asymmetry. Pro funds pay for satellite imagery of Walmart parking lots to predict same-store sales. They buy aggregated credit card data to forecast earnings. They license real-time corporate sentiment scoring. They have private analyst calls. You have a free Yahoo Finance feed. By the time public information reaches you, it's been priced in for hours, sometimes days. You're not late by accident. You're structurally late. Retail loses not because retail is stupid. Retail loses because retail is playing without the speed, the size, the data, or the discipline of the other side. If you still want to do this, here's what actually works for individuals. None of it is sexy. All of it is mechanical. First, trade slower. The shorter the time frame, the more you compete with algorithms that have a structural speed advantage. The longer the time frame, the more your edge can come from analysis, patience, and judgment, which scale less with latency. A daily time frame trend strategy doesn't care about microseconds. A 5-minute scalping strategy is competing with people whose servers are in the exchange building. Pick the game where speed isn't the edge. Second, mechanize the rule. Whatever your strategy is, write it in code. If you can't write the rule down precisely enough to code it, you don't have a strategy, you have a hunch. Once it's code, you can backtest it on real historical data. You can see if your idea actually has edge over thousands of trades, or if you've been pattern matching on 3 lucky wins. Most retail traders refuse this step. The ones who don't refuse, they get answers. Often the answer is, this doesn't work. That's also useful. Third, backtest honestly. Overfitting is the silent killer. If you tweaked your parameters until the equity curve looked beautiful, you didn't find an edge. You found a way to fit noise. The professional discipline is walk-forward validation. Train on the first half of history, test on the second half. If it doesn't work on the test data, it doesn't work. Most strategies that look amazing in backtest fail this test, almost all of them. Fourth, size honestly. Even if you find an edge, don't bet your life on it. Allocate small. The math of the Kelly criterion says, even with a real edge, position sizes should be modest. The math of human psychology says, even smaller. Treat trading capital as the experimental fraction of your portfolio, not the whole thing. Here's the thing nobody tells you. The market is not random. It's a rules-based game played by participants with extremely different equipment. The professionals turned trading into engineering, measurable signals, controlled risk, mechanical execution, honest measurement. Most retail traders try to play the same game with intuition, screen staring, and emotional money management. The outcome is not surprising. The outcome is structural. The retail traders who do survive, and a small percentage do, are not the ones who beat the market with their gut. They're the ones who narrow the gap. They mechanize. They size small. They accept losing months. They run their strategy through regimes where it works and turn it off in regimes where it doesn't. They are, in spirit, running their own small fund. The romance of trading dies. The math takes over. You don't beat the algorithms by being faster. You beat them by playing a different game. Slower, smaller, more honest. So, 70% of volume is algorithmic. Algorithms are not magic, they're pipelines. Breakout wins big and loses often. VWAP works until the regime breaks. Retail loses to bias, cost, and information gap. And the only retail traders who survive are the ones who narrow the gap by mechanizing, measuring, and sizing honestly. That's the whole game. If this was useful, subscribe. Next, how high-frequency trading actually works. No hype.